Hi, this is Ed. Welcome to our session on saving and investing. Growing your wealth, or we hope anyway. That's the whole plan of it. We're going to be looking at a couple of different things today. Really, is just what we're going to be looking at the differences between saving and investing. First of all, we're going to probably just reiterate stuff you already know about how to save, but also some important pointers to think about when you are actually setting up different savings vehicles. Then we're going to look at something that perhaps a lot of you won't have thought about yet, which is investments and how to go about doing those safely. We're going to look at the pros and cons of saving and investing. That'll be through a short film. And then we're going to give you an activity whereby you are going to become fund managers of £10,000. So in this activity, you're going to need, first of all, the sheet, which hopefully has been supplied for you. If not, you can download it off of this website. And then you're going to look at a little bit of introspection and look at the type of person you are, whether you're risk averse or you're very gung-ho and out there for all the risk. And then you're going to start applying your knowledge to invest that £10,000. And then we're going to start rounding off with inflation and its effect on saving and investing, and then a quick summary at the end. So first of all, I'll pose you a question. What, in your view, is the difference between saving and investing? Well, you'd probably come up with a couple of different ideas, but for me, I suppose I would sum it up with saying savings are completely safe, risk-free, and very much for the short term, whereas investments are very much more long-term and do incur an element of risk, and generally the more risk that we take, the more potential reward that we get. So if we look at the actual dictionary definitions of savings, it's money that you've saved, especially through a bank or an official scheme. And then investing is money to put into financial schemes, shares, property, or a commercial venture with the expectation of achieving a profit. So if you sort of bear that in mind, that I think savings are very much short term and investments are very much long term, that probably sort of summarises the two differences. But we'll get that confirmed in a minute through a little film. So let me ask you, just as a little group chat to start, we'll take a couple of minutes by putting this video on pause, just to come up with all the different ways that you guys currently take to save. If you're watching this on your own, just jot a couple of ideas down. Okay, so hopefully you've come up with a few of these different ideas. Probably the first one was cash. We don't use so much cash these days, but certainly piggy banks or bottles, something like that, is probably pretty much how we all started. It taught us then the importance of just saving regularly and saving little bits of cash here and there can soon mount up into a reasonable amount of money. Now, a lot of you will have savings accounts, so that's an account in the bank or a building society separate to your normal current account. And you may be enticed with different rates of saving in there, different percentage APR rates on those savings accounts. And we can actually improve those again, those interest rates that you're going to be getting, by opening a regular saver account. So you have to put a certain amount of money in every month. But even if it's just a fiver, you can actually still get yourself some really good deals. One of the things I use these days, because I don't use cash as much as I used to, is roundups through an app. I actually use an app called Plum. There's plenty of other apps out there as well, which rounds up any purchase I make to the next pound and puts the difference into my savings. So, for example, if I buy something for £3.19, Plum rounds it up to £4 for me and then banks the 81 pence into a savings account, which is kept with Plum. Doesn't actually pay me any interest. So when there's a reasonable amount in there, I can take that out and put it into my savings account. Some of you will probably be aware of ISAs. Now, ISAs cover quite a few different things. When we talk about an ISA, we generally talk about a cash ISA. And our ISA will give us a rate of savings, but it differs from a normal savings account, because in a normal savings account, you will be charged tax on your interest that you earn. Now, provided you're earning less than £12,570 a year currently, that's not actually going to affect you at all. But certainly for your cash ISA, once you are earning more than that, that is going to show you a reasonable saving on any interest that you might have to pay on your interest. There are also junior ISAs out there which may have been opened up for you when you were younger. There was a government scheme that you will have all been included in, whereby your family were given £250 to invest on your behalf when you were born. That becomes yours at the age of 18. That was probably put into a cash ISA. Check with your folks to see if that was done. If not, there are ways to find out, because the government would have invested it on your behalf if your family didn't do it for you. That money is out there and it can be worth anywhere now between 500 and 750 quid. So please don't be one of the 8 billion pounds worth of losses on those that are unclaimed. Make sure that you actually get that money that is rightfully yours. And the last way that I would like to sort of have a quick chat about saving is through something called premium bonds. Now, premium bonds are just like a never-ending lottery ticket. You buy your premium bond, it goes into a draw every month with the top prize of being £1 million, and loads of prizes all the way down to £50. And if you don't win on a given month, then you don't lose your money at all. You just keep your money and go into the next draw and the next one and the next one. If at any point of time you want to get your money back out of the premium bond scheme, which is government backed, by the way, then you can. And you can do that either online or through the post office. So there's 6 different ways there of saving, and hopefully you're using 1 or 2 of those already. So what are the key elements of saving that I would suggest? Well, for me, little and often is the way to go. I was taught to try and save just a coin every single day that I went to bed by putting that into that bottle, that first bottle I showed you. And never try to over save, because as soon as you do, it gets painful. So we want something that's pain free. And if it's pain free, the chances are we'll carry on doing it long into the future. There should be no risk associated with our savings accounts. It would be nice if they paid a little bit of interest, which would combat any inflation that's around. And we'll talk a little bit about that later. But you should not be trying to overextend your savings to earn more money out of it. That's a job of our investments, but not our savings. So as I say, keeping up with inflation by earning that little bit of interest. Need to be able to get that money out when you want it. Don't leave it too late to get it out. It needs to be available when you want it. And I would always suggest keeping your savings nice and diverse. So maybe having some in cash, some in your savings account, maybe an ISA, and maybe some premium bonds. That's always a good diverse way of saving. And then if you are a regular saver, by putting a certain amount away every month, try and automate that so that it comes out of your salary on the day you get paid, and you don't even have to worry about it. So that pretty much sums up saving, and I'm sure most of you are pretty aware of an awful lot of the things that we're going to look at on those. So let's go on to some investments. Now, there are literally thousands of different ways to invest, and you've probably heard of some. We're going to go over some of the major ones here, and I'll explain exactly what they are. So first one being stocks and shares. So stocks and shares are just little parts of a company that you can buy, and there are 2 ways that you earn money out of stocks and shares. You can either buy stocks at, let's say, £1, and if the company does very well, those stocks become in demand, so the price rises. There are more buyers than sellers. So you can then sell them at a later date at maybe £2, so you make your £1 profit on your stock. The other way that you make some money on stocks and shares are through dividends. And dividends are small portions of profit that company makes that are paid back out to the shareholders every year or every 6 months. Not all companies will always give a dividend, but most of the big ones certainly do. And if you can get yourself a nice diverse portfolio of shares in lots and lots of different companies, that can actually add up to a really nice amount of income coming in. The next ways of investing are bonds. Now, bonds can be quite confusing. Now, all a bond is a certain amount of money that you either give to a government, those are government bonds, or to a company, and those are corporate bonds. Now, bonds are rated anywhere from AAA, which is the very, very most secure, which pay a very low amount of interest, all the way down to much more risky Cs. And those C-rated bonds are generally corporate bonds, and the smaller the company and the less successful the company, the more interest they will offer you to try and entice you to put some money into that company. Now, companies and governments issue bonds to try and raise money. So if our country needs to raise a certain amount of money to pay for certain things, they will issue more government bonds, and the UK government bonds are actually called gilts. So if you've heard of a gilt, that's exactly what it is. It's just a bond that's raised by our country. And government bonds generally run for anywhere between 5 and 30 years. So they're very long-term things. You don't have to keep them all the way through. You can sell them back at some point and get your money back. Corporate bonds tend to be a bit shorter in life, and they can be anywhere from 1 year up to 5 years, although there are longer ones. But do bear in mind that obviously the bond can be changed in its rating. So a AA bond doesn't always stay a AA bond. If the company or the country doesn't do so well, that can be downgraded to a single A, and then it will be more difficult to sell. So bonds, just another way of earning some interest on a chunk of money that you want to invest. We mentioned in savings cash ISAs. There are also stocks and shares ISAs. Now here it's a sort of a mixture of your ISA and your stock portfolio. So you can buy some stocks and shares, put those into an ISA, then your earnings are protected against tax on your dividend. So it's, again, a nice way of wrapping all those things up in a nice tax-efficient scheme. There is a limit on the amount you can put in there, but it is certainly worthwhile thinking about. Now, stocks, bonds, all of those sort of things does sort of mean that you will have to do a bit of homework. You'll have to think about what type of companies you want to invest. If you can't really be bothered, or that doesn't really interest you very much in looking into all of that, you could go into something called a unit trust. Now, you can put some money into a unit trust on a regular basis, or you can do it as a one-off. And then some experts will use that money, tie it in with loads of other people's money as well, and they will run a stock and a share portfolio for you. There may be other things in that unit trust as well. And the value of the units in the unit trust goes up and down as the unit trust is successful or less successful. So you could buy into a unit trust at 180. If the unit trust goes up to 190, you've made 10 units profit, and you can cash out and take that money as well. But again, as with all investments, do look at those as long term. The next one, I suppose, is something that everyone's aware of, but very few people think about as an investment, and that's property. Now, obviously, the clearest way of going into property is buying a house and then waiting for it to go up in value and selling it again, and maybe living in it in the interim. You can buy second properties. That is then open to capital gains tax, which you can find out all about on our tax session. But that is tax on the profit that you might make on the property. But the big downfall of all of those is you need an awful lot of money to get involved in the first place. But there are property funds out there, or there are stocks and shares in property companies that will sort of reflect the movement in the property market. So without exposing yourself completely into the whole house or the whole flat that you might be interested in, you can actually put a small proportion of the value into one of these funds or into the shares of the property companies, and you can actually make some money that way. And then the last one I've put in there, I could have picked anything, but I've actually picked antiques. I could have put wine, or I could have put cars, or all sorts of things, but anything that you've got an interest in, really, that you can actually appreciate the beauty of them while they're there, and then you can sell them out at a profit at a later date. I guess that you're then getting the best of both worlds. You're investing in something that's rising in value over time, but you're also enjoying the thing that's there while you've actually got it. Art we could put in there as well. So what would I consider to be the key elements of investing? I think very first up, you have to understand your risk appetite. Now, by that I mean, are you a type of person that really doesn't like risk, so you hate losing money, so you like to keep things nice and safe? Or are you the type of person that is prepared to risk a bit to win a bit? Or are you the type of person that wants to risk a lot to win a lot? Only you will know that, and I'm going to encourage you to have a think about how that type of person that you are when we do our exercise in a minute. I would always suggest that we diversify our investments, so we don't put all of our money into stocks, and even within stocks we then share those around in different sectors, so maybe some in banking, some in gaming, some in motor sport or motor cars rather, some in well, anything really. I mean, just as long as it's diversified around, do your homework and find out what the best companies are within those elements. And then we could put some more into unit trusts, and we could put some into one of the things that we're interested in. So we have a nice little varied share portfolio, beg your pardon, investment portfolio, so that if one doesn't do so well, then perhaps the others will pick up for it. So that's always a good idea. But when we're going into investing, we have to appreciate that things may make money, but they may make money over time, and it won't always be a straight line. So be patient. Don't buy something today thinking that you'll make money on it within the next year. It might take 20 years to actually give you a really good return. And if we cash out too early, maybe we miss the big bounce on something. So be patient. Think of that money being tied up for a significant amount of time. But of course, if you do need to get it out for any emergency or a change of plan, then you can do that. But maybe you'll be a little bit disappointed on the return that you get. Also, be careful with some of the longer term things that you might buy. There could be penalties if you actually sell those back before they get to maturity, before they get to the end. And those are some of the fees that you could get into. Unit trusts may charge you a small fee as well. Anyone that manages your investment portfolio are likely to charge you a fee, and that will be a percentage, a small percentage of the value of the portfolio. But if you're paying a company 0.5% to look after your investments and they're earning you 7%, then you're still 6.5% up. So don't balk at the ideas of paying fees if you're getting really good management as well. Right, I'm going to give you a little film to watch now, which is just going to give you the pros and cons of saving and investing, and it sort of spells out everything we've been speaking about.
The pros and cons of saving and investing. Imagine saving and investing like a race between a tortoise and a hare. Both are chasing an investment goal that is always moving because of inflation. Every time you add to your savings, the tortoise takes another step towards your goal. You will also earn interest on your savings. But if you rely only on the interest, it will be difficult to catch up, because interest and inflation often move at around the same rate. Save enough and eventually you will get there. It's slow. It's steady, it's safe, and you'll always know exactly where your savings are. In short, it's predictable. By investing your money in the hare, even without adding more money, he might be racing towards your goal. However, the hare is not always predictable. He might get most of the way there, then slow for a while. He could even run away from the goal and end up further away than the tortoise. Therefore, backing the hare carries some risk. As a responsible investor, you should look at investing in the long term. Yes, it's possible to make a lot of money quickly, but in order to do this, you usually need to take more risk. Should you get it wrong, the results could be disappointing. By looking at investing in the long term, you'll have more time to educate yourself, time to make more than one investment, time to cash out on your investments at the right time, and if some of those investments disappoint you, you'll have time to catch up. You can always start off small and invest more as you become more comfortable with the investment process.
Okay, so that pretty much sums up everything we were looking at just now. So we're going to go now onto an activity. Hopefully you've got that sheet there or you downloaded it from the website. So you are going to be investing £10,000. So at the very top of the sheet, you can see that I would like you to take a little bit of time to try and work out what type of person you are when it comes to risk. So tick the one that you are on the right hand side. So if you think that you're a balanced type of person, you like some risk and get some average returns, and at worst you're going to probably break even, then tick box number 3 on the top of the sheet. Okay, once you've done that and decided what type of person you are, I'd like you then to look at all of the different investment vehicles that I've written down on the chart below. There's a couple of spare boxes there as well in case you wanted to add some of your own. And then decide what risk rating 1 to 5 you would give each of those different vehicles. So for example, cash, we could say that that's very safe, little but no risk, but with very little return, will not lose money. So we could put in the risk rating for cash, perhaps number 1, if that's what you think it is. Then you can decide either the percentage of £10,000 you want to put into cash or the amount of that £10,000 that you want to put into cash, completely up to you. If there are anything down there that you don't know or you don't understand, then use your phone just to check it out and find out what that is through Google. If you still don't know or you prefer not to check it out, then steer clear of it. Just like real life, you should not be investing in things you don't know what they are. So pause the video now, give yourself 5 minutes, work with a partner if you want to, and come up with your investment strategy. And you can actually discuss this at maybe a future lesson. Okay, well, hopefully you came up with your idea of an investment strategy. This would be a really good thing to discuss as your little group in front of the class. Explain why you thought this was a good idea. And I would think that this would be something you could do at a future lesson. So just to finish off what we've been looking at in saving and investing, as we've got interest working in our favour, we've actually got inflation, which is working against us. Inflation is the erosion of the value of the money in your pocket or in your savings account. Just to give you an example, if we think about how much 90 pence bought for in petrol back in 2020, it might have bought us 1 litre. In 2023, 90 pence buys us just 3/4 of a litre. So we could argue that inflation has changed by 25%. So 1/4 of the value of that money when it comes to petrol has disappeared in that 3 years. If we think about local pizza, £9.50 bought us an extra large pizza in 2020, but now £9.50 only buys you a large pizza. So we've actually lost some of the pizza for our money. You notice I've made it so that we're losing goods for the same value of money rather than being charged more money. But we could look at it that way as well. So we could say in 2020, 1 litre of petrol cost us 90 pence. But in 2023, 1 litre of petrol costs us £1.39 or whatever it might be at the moment. So there's 2 different ways of looking at inflation, but each way means we're actually being able to buy less or we're being charged more for the same thing. Well, I hope that sort of cleared up a few things on saving and investing. Save regularly, invest wisely, and I'll see you at the next session.